So here's what here's a more near-term view of what's happened to copper. I think it's interesting to note when it bottomed. It didn't actually bottom with the markets. It bottomed in December. It's back up to about here now. We're sort of expecting a bit of consolidation in this range. I mean, 225 was probably a bit too enthusiastic, frankly. Dave and I were thinking $1.75 to $2 is probably more realistic, so it may come back to about that level and bounce around in there. One thing that I want to make a note of too, in terms of copper supply, there's been a lot of comments about how unrealistic it is that copper's gone up because of the Chinese buying. There's two things I want to point out. The Chinese, like most large industrialized countries, have government stockpiles. It's not that uncommon. Japan's got them. The States used to have them. They don't have as many anymore. They've pretty much sold down their strategic stockpiles in 2005, 2006. I mean, I talked to a hedge fund guy a couple of weeks ago that thought it was hilarious that China was in the market. You know, like, I can't believe these guys are dumb enough to buy 300,000 tons of copper at $1.80. It's like, that's the copper they sold you for $4 2 years ago. Not so stupid. I mean, it's inventory management, plus, and it's an important thing to keep in mind too, is the other reason why they're doing this, it is sort of inventory management. China thinks fairly long term. Copper is something we're focusing on in addition to gold, because the thing about copper is it's one metal that China is not a net exporter of. It's a fairly big net importer. I mean, zinc we think will do okay later, but China's still a net exporter of that, so there's probably some games to be played in that market still. Copper, not so much. If they want the stuff, they got to go out and buy it. What they're doing when they buy things like copper, and they're buying zinc, they're buying aluminum, they're buying a whole bunch of stuff, the reasons why they do this is it's also a way for them to get rid of some US dollars. It's a simple way to do it. They're going to use the stuff anyway. The prices are good. And 300,000 tons of copper sounds like a lot. Like 1 million tons of copper sounds like a lot. But if you think of it in terms of the foreign reserves that they've got to deal with, it's nothing. 300,000 tons of copper is 0.2% of their foreign reserves. I mean, it's nothing. Gold, I mean, I'm sure you've been heard about gold endlessly, so I'm not going to spend too long on it other than to go through my view of things. You know, we think gold did a great job. It did its job. You know, in the last 9 months, I mean, there was no end of, you know, we had all kinds of people going crazy and phoning us and emailing us during this period going, you know, what the hell's going on? Well, a lot of people buy gold, they buy it as insurance. You buy house insurance, your house burns down, what do? You cash the insurance in. I mean, that's what was going on here. I mean, Dave and I aren't gold bucks, I mean, maybe we got a slightly different view of it. I mean, we think gold did its job beautifully. I mean, it did what it was supposed to do. It protected people's portfolios. Now you've seen it climb again. You know, we think it's going to sort of stay in this range, although the upside potential for it is of course, two things that I'm sure you've been talking to about endlessly. You know, this sounds really simplistic, but I don't mean this to be a toss-away line. I'm dead serious. It worked is the most powerful argument for gold ownership right now. You know, why do people buy stuff at an investment level? Because it works. It works sounds overly simplistic, but that basically describes 90% of the mutual fund industry in the world. Why did you buy that? Because it was going up. That's the reason most of the time. Gold hasn't really had that argument that well most of the last 20 years. So I think some of the investment buying that you're seeing because it worked is quite important. And personally, I mean, I don't have anything like the gold price predictions that some guys, some friends of mine in the business do. But if it's ever going to get to those $2,000, $3,000, $4,000 levels, it's going to be on it work. It's going to be on investment demand. Nothing but investment demand is going to buy enough gold fast enough to drive the price that high. I mean, gold bugs will not make the gold price go to $4,000. There aren't enough of you. If you all thought gold was going to be $4,000 and there were enough of you, it would be $4,000. It's not $4,000, ergo, someone else has to do the buying to make it go there. And I think investment buying is what can do it. I know there's been a lot of concern about Indian demand lately because it did fall off a cliff. We're pretty comfortable with Indian demand because it's actually savings demand. If you go into gold or you look at the World Gold Council, most of it gets lumped in as jewelry, but it's not really jewelry, it's savings. That's simply how they do it. But they're very smart traders in India. They don't chase the price. But I think if you're concerned about there being a floor under the price, I'm fairly comfortable the Indians will put it there. Because as soon as the price started coming back in the last month, they showed up again. I mean, they're simply very smart buyers. Those guys don't chase the price. They're very smart traders. What's going to make this happen, and if we're going to see a higher gold price in the medium term, this is what's going to make it happen. This is a TNX chart, 10-year note yield, going along merrily until late last year, and then slipped, fell off, panic buying, everybody freaked. So obviously, when this is doing this, it's because bond price is going up, right? This is the yield, not the price. So the more this is dropping, the higher the bond price is going. So panic buying drove this down to 2 on a 10-year, which is amazing. I was like a lot of other guys late last year, looking at bond screens, just kind of shaking my head, going, that doesn't happen, but it did. Then it came back up, and this, I guess you could say this is optimism, I suppose, is the simplest way to put it. People were moving some money out of the treasury into other stuff. This drop here was Ben riding to the rescue, and he did that for a good reason. I know a couple of guys this morning mentioned the 3% level, which is here. I mean, basically, the problem Bernanke's got, and it's not really Bernanke's problem, it's really the Treasury's problem. As we noted, the Treasury's got to sell $3 trillion worth of notes in the next 7 or 8 months. That's going to be really bloody hard to do. And the most difficult thing about it is they have to do that, and at the same time, they've got to keep interest rates down. Yes, the Fed's dropped rates to essentially 0, but it doesn't mean anything, because the Fed doesn't lend most of our schmucks money. The interest rate that means something comes out of the market, not out of the Fed. The Fed gives opinions and suggestions, but it's the market that decides interest rates. The only way, in my mind, that the Treasury can raise that kind of money and keep this yield in this area is he's got to be the bid, pure and simple. It's not just about, people talk about quantitative easing. It's all money supply. It's all money supply. To me, it's not about money supply. It's about Bernanke being the bid. He has to be the bid. If he's not the bid in the Treasury market, there's no way these guys are going to be selling $75 to $100 billion in notes every week for the next year without the yield going like this. And they can't have that happen. They simply cannot have that happen. If they let the bond market do its own thing and try to sell that much paper, yields will go to 5 or 6 or 7 or 8%, and they're screwed. I mean, kiss goodbye to the expansion, whatever of it is coming. He's got to be the bid. It's going to have the effects that it will have on monetary expansion, and probably beneficial effects on hard asset prices like commodities, but it's important to understand why this is being done. I don't think it's some nefarious scheme to just expand the money supply. He has to be the bid. This is the market that they're worried about, because if they can't sell those notes, they won't. Okay, so they've got to be the bid. And in doing that, and being the bid, essentially what the Fed does is it goes into the market, it buys treasuries, and gives people money that it just invented out of thin air to pay for this bond. It's money supply creation. I mean, that's
monetizing the debt.
Well, yeah, it's monetizing the debt, and I think they have to do it. And I mean, you guys tell me. Here's a group of upstanding American taxpayers. How realistic do you think it is that any politician, let's be honest here, could come to the market in 3 years and say, okay, here's what our balance sheet really looks like. We're going to raise income taxes by 20% across the board, and we'll probably throw in a VAT tax at 15 or 20% so we can deal with this debt. Is everybody okay with that? Who's going to win an election on that platform? Nobody. I mean, it's just good, bad, or indifferent. It's never going to happen, and that really only leaves them the old-fashioned, common, end of empire way of dealing with it. You basically monetize the debt and you try to cheapen it as much as you can with inflation. And by cheapening it with inflation, nominal incomes go up, and it becomes easier to basically pay the debt off. I mean, the U.S. isn't the first country to go through this; it won't be the last.